Pursuant to the committee rules, each side will have 15 minutes for opening statements. Without objection, all members' opening statements will be made part of the record. I want to recognize Mr. Gutierrez and Mr. Eliason, members of the full committee participating in today's hearing who are not members of the subcommittee. Without objection, is so ordered. We meet today to focus on the work of the U.S. Securities and Exchange Commission. Although she is no stranger to us, this hearing also represents the first time that Mary Shapiro will testify in her new capacity as head of the commission. Chairman Shapiro has, of course, taken over the helm of a much beleaguered agency. In recent months, many have criticized the commission for its lack of diligent enforcement. The commission showed particular ineffectiveness when, despite numerous warnings, it failed to uncover the Madoff scandal. This $65 billion fraud has caused extreme hardship, if not ruin, for far too many individuals, pension funds, and charitable institutions. Our panel has already examined the Madoff affair in great detail, using an unfortunate episode as a case study to examine the gaps in our existing regulatory structure and to identify solutions to fill those holes. The recent public assessments of Harry Markolopoulos and the Government Accountability Office show an agency in distress. To restore investor confidence in our markets, the Commission must expeditiously change its ways, the way it does business. Since her return to the Commission as chairman, Mary Shapiro has moved aggressively to focus the agency on fulfilling its key mission, protecting the investors. She has beefed up the importance of the enforcement unit, pursued significantly more enforcement actions than her immediate predecessor, and removed unnecessary hurdles that slowed progress in enforcement cases. In less than 6 months, she has also replaced nearly all of the agency's senior officials. In nominating Mary Shapiro, President Obama remarked, "Mary is known as a regulator who's both smart and tough, so much so that she's been criticized by the same industry insiders who we need to get tough on. I know that Mary will provide the new ideas, new reforms, and new spirit of accountability that the SEC desperately needs so that fraud like the Madoff scandal doesn't happen again." Without question, I wholeheartedly concur with the President's assessment. In her short tenure, Chairman Shapiro has displayed a commitment to implementing the reforms needed to change the internal culture of external perceptions of the Commission. The Commission, however, must continue to take bold and assertive action as it moves forward to bring enforcement actions against wrongdoers and to rewrite the rules governing the industry to better protect investors. Without further action to finalize regulatory proposals on proxy access, the custody of client assets, and short sale restrictions, investors will lack the real protections that they need. The hard work on these matters, therefore, lies ahead. As the Commission works to put in place new rules, Congress must also work to update our securities laws. In this regard, Chairman Shapiro has already transmitted an ambitious set of 42 legislative proposals. The Commission's Inspector General has also offered some ideas, and the Obama administration has, of course, already relayed general concepts and specific legislative proposals. I am now developing a bill based on these useful recommendations. On the many suggestions already proposed, one important one stands out. We ought to put in place new standards that reward whistleblowers when their tips lead to catching fraudsters. By encouraging whistleblowers to come forward when they know of wrongdoing, we will leverage the Commission's limited resources and increase the number of cops on the beat. Improving the Commission's overall operation and performance will additionally require a significant increase in its budget. Chairman Shapiro has noted that the agency lacks resources required to match increasingly sophisticated markets. Fortunately, the House will soon consider a bill providing for a modest increase of 8% in the Commission's 2010 budget. But we must do even more to remedy these constraints. The financial crisis shows what happens when unbridled capitalism lacks a strong regulatory check. We must therefore seriously consider the Commission's request to raise its 2011 budget authorization by an additional 20%. Alternatively, we might decide to put the Commission on the same independent footing as other financial regulators by moving the agency outside of the appropriations process. In closing, I look forward to Chairman Shapiro's testimony today. Her comments will help us as we embark on an overhauling financial services regulation. I'd like to recognize the Ranking Member Garrett for 3 minutes for his opening statement.
Thank the Chairman. Thank the Chairman. And I welcome you here today and appreciate the opportunity to meet with you on Friday to chat about some of these issues as well before today's hearing. You know, there are so many fronts on which the SEC is actively engaged. It's a little daunting to know exactly where to start. You certainly have your hands full as the new chairman of the agency, and I think it's fair to say is under a lot of scrutiny right now for the events that have taken place over the last several months and years. One place to start is with the SEC's budget. In the House Financial Service Appropriations Bill recently passed out of the committee, for the first time ever, the SEC would be funded at more than $1 billion. In a recent letter I just received from one of Bernie Madoff's group of victims, they ask why, given the SEC's recent investor protection and enforcement track record, is Congress seriously considering giving the SEC even more money and more authority to regulate financial services? I think similar questions are on a lot of people's minds, and I look forward to addressing that issue. In the policy areas on your plate, one of the areas I've been increasingly engaged in is the area of over-the-counter derivatives. As I said for a number of times in the past, 94% of the 500 largest global companies use derivatives to manage risk. Policymakers, therefore, need to tread very carefully as we regulate options for these markets. See, if over-regulation or improper regulations might sound good politically, I'm sure, but there's a lot of major unintended negative consequences that could come about, not just for the financial markets, but for the broader economy as well. Now, it's my understanding that the SEC and the CFTC, along with the administration, have engaged in discussions over the OTC derivative regulation, including discussions regarding which agency should have jurisdiction over particular pieces of the market. So I'll be interested to hear about particular discussions and any maybe disagreements that the SEC has with the CFTC on derivative regulation. I'm also interested to hear if there are any areas of current CFTC jurisdiction where you feel they're better suited for the SEC. On another front, the administration last week released draft legislation seeking to establish consistent standards for broker-dealers and investment advisors that would give the SEC powers to ban certain forms of compensation that are, quote, not in the investor's best interest. This comes on the heels, of course, of the administration's proposals of a so-called Consumer Financial Protection Agency. When you think about it, both proposals sort of reflect a government knows best mentality that will likely restrict consumer choice and may be embraced by trial lawyers for unnecessary litigation. So I'll be interested to hear from the Chairman regarding the SEC's input on those proposals and to what extent you're comfortable with dictating on how a firm should compensate employees. And finally, I mentioned at the beginning of my statement that there are a whole host of other issues that you're currently examining, and I'll be interested to hear an update on your proposed rules to restrict short selling, as well as your thoughts on different ideas to reform credit rating agencies that we talked about, which I know the Chairman is also very interested in pursuing as well. So I welcome the Chairwoman to being with us today, and I look forward to your discussion. Thank you.
Thank you, Barrett. I'll hear from the gentleman from New York, Mr. Ackerman.
Thank you, Mr. Chairman. Good morning, Chairman Shapiro. Chairman Shapiro, there are an awful lot of people watching this hearing that aren't too interested in regulatory reform. They're not too concerned about resolution authority or the clearing of derivatives. And they aren't too worried about whether Congress complies with your request to increase funding for the SEC Enforcement Division. Madam Chairman, the thousands of now penniless victims of Bernard Madoff's Ponzi scheme are interested in just one thing: making sure their government lives up to its word. As you know, the Securities Investor Protection Corporation, that's investor protection, indicating that it has something to do with protecting the investor, SIPC provides insurance of up to $500,000 to securities investors in the event that a broker-dealer fails. It's been 7 months now since the collapse of Mr. Madoff's fraud, and to date, of the over 15,400 claims that have been submitted, only 450 victims have received even a portion of their SIPC insurance. Part of the delay stems from the confusion over the eligibility requirements for SIPC coverage. If you believe the law as interpreted by SIPC's General Counsel Josephine Wang, the SIPC is obligated to provide up to $500,000 per account for securities to any investor that believes that they own the securities in Madoff's investment statements. But if you believe Irving Picard, the court-appointed trustee in the Madoff case, based on a judicial precedent from the 1920s, the SIPC is obligated to insure only the funds that Madoff victims initially invested, minus any withdrawals. According to Mr. Picard's interpretation, many Madoff victims are not entitled to their insurance payments. Madam Chairman, that Madoff was able to conduct his fraud unmolested by the SEC for decades, and despite the repeated red flags raised by Harry Markopoulos, is tragic. That the court-appointed trustee in the Madoff case is seeking to delay and ultimately deny the insurance payments due to Madoff's victims is absolutely shameful. Many of Madoff's victims are in complete financial ruin. Many have lost their homes and have moved in with their children or friends. The lucky ones don't know how to make their next mortgage payment. At a minimum, they deserve the insurance they believe and to which the law says they are entitled. I hope that you can put an end to the confusion today by clarifying the SIPC's eligibility requirements. And I yield back the balance of my time.
Thank you, Mr. Ackerman. Mr. Bach is recognized for 3 minutes.
Thank you, Chairman Shapiro. As Chairman Kanjorski said, this is your first appearance before the Financial Services Committee since you've been sworn in. And I want to compliment you in your short tenure as the agency's chief executive. You've embarked on an ambitious regulatory agenda and an equally important review of the SEC's internal operations. And I have been impressed in a very favorable way over the way you've conducted the affairs of the agency. Chairman, there's a strong need for regulatory reform. I think we all agree on that. You certainly do. However, I am very concerned that the guiding principle of much of the administration's proposals, whether it's health care, energy, or financial services, is what could be a heavy-handed intervention into what has traditionally been the private market on private choices and private affairs. In each of these areas, the key theme seems to be rationing or permitting certain conducts but determining others are not appropriate. The administration wants to create, as you know, a government health insurance option, and my fear is that if it's like those or in other countries, it will result in rationing of health care, limiting choice, and erosion of quality. The cap and tax plan, I think, is another example where they will significantly ration energy use, the use of coal, other things, discourage it. And with financial services, it appears in many cases the administration wants to ration credit to consumers and businesses to make determinations on whether certain transactions are appropriate, and to do so, I think, in a very intervening way. And let me just give you one example as it relates to the SEC. With the Consumer Finance Products Agency, and this is not the example. You know, it appears to me that they could function as a contract approval and a credit rationing agency. That's a fear. But now, as for the SEC, last Friday, and I'm sure you heard Treasury Secretary Geithner say that the government was looking at, and the government will be looking at every private derivative transaction that isn't cleared to determine if they were spuriously customized to avoid a clearinghouse. How can the government possibly look at tens of thousands of daily derivatives transactions to determine if the intention is to avoid clearing? If a derivative trade is ruled invalid, has to be unwound, what happens to the contractual rights of the parties? I worry that we are asking regulators to function as a behavioral psychologist. Let me conclude by saying, if the SEC has no one that could understand the Bernie Madoff trading strategy, how are they possibly going to be able to understand a private corporation and its counterparty's decision to mitigate business risk? What the administration is doing is turning the SEC into an IRS where fear of second guessing causes decisions to be made based on fear of excessive punishment, and fear of having to prove the unprovable rather than basing decisions on sound business judgment. Thank you, Mr. Chairman.
Thank you. Mr. Capuano, recognized for 2 minutes.
Thank you, Mr. Chairman. Madam Chair, welcome. Over the last couple of years, I honestly wouldn't waste my time coming to a hearing with the SEC chair because I didn't like anything that they were not doing, because they weren't doing anything. So therefore, it wasn't I didn't like what they were doing, they weren't doing anything. And waste of time talking because everybody there believed do nothing, let the market flow, what, no big deal. Now we are where we are. Today, to some level, it's a little early, but on some levels it's almost, I'm not sure I'm going to stick around too long because everything you're doing, I like. Now, that doesn't mean I'm going to like every detail, I'm going to like the final results, and we'll nitpick here and there. But in general, I think you're going in exactly the right direction. And I will tell you that I encourage you to continue doing it. I know that you're working with the committee to try to get some legislative relief on some items that you need. I think that as, well, not an investor, but an indirect investor through 401ks and the like, and as a person who has some responsibility for overseeing the current system, I am much more satisfied and happy that we finally have an SEC that is awake and understands that there is a role to play to keep the system within the bounds of propriety, to keep the system so it won't break again. In balancing that, obviously, with the desire and the benefits of a strong market and a strong system, with an innovative system that brings risks with it. There's nothing wrong with risk. The question is how much and who pays for that risk. And in general, the things you're talking about, credit rating agencies, the things you're talking about with the uptick rule, I think you're heading in the right direction. And again, I'm going to stick around for your testimony just to make sure that I haven't missed something. But other than that, if I leave before I get to ask you any questions, it's not because I'm not interested. It's because on some levels, I think this hearing's a little premature. Not really, but on some levels it is, because a lot of these things, I know they're in the works. We are in the works trying to deal with the regulatory system. And until we know where that all goes, I think some of those questions will have to wait. But I just want to say thank you. Thank you for beginning to restore my faith in the system that we have created.
Thank you, Mr. Capuano. Now the gentleman from California, Mr. Royce, 3 minutes.
Yes, thank you. Thank you, Mr. Chairman, for holding this hearing. I think it's interesting that we're talking about 16 years time frame that the SEC was in the process of examining, or had an opportunity to examine, Bernie Madoff. And I think one of the most troubling hearings that we had here was the hearing where we heard from Mr. Markopoulos about the Madoff case. And prior to that, I had an opportunity to talk to some of the investigators for the SEC about that particular case, because it was absolutely astounding what Mr. Markopoulos was telling us. What he laid out was the world's biggest Ponzi scheme, and how over a period of years he repeatedly attempted to reach the SEC and actually found an individual at the Boston branch, Mr. Ed Mannion, who was not like, as he described, the over-lawyered SEC, that for years after years had failed in this endeavor. He finally found a guy who had experience as a portfolio manager, who actually knew what he was doing, who had experience as a trader. And when he looked at this data, he instantly saw the same thing, the same reality that Mr. Markopoulos saw. But Mr. Mannion was silenced internally in the organization. Why? He wasn't a lawyer. He was not part of the over-lawyered offices in New York and Washington, and they saw to it that that went nowhere. Now, on several occasions, Mr. Markopoulos attempted on his own then to go in and to explain to SEC officials in detail why Mr. Madoff's returns were simply not possible given the investment strategy. And he noted, and this was the astounding aspect that I explained, the SEC investigators explained this to us, they affirmed this, there was just a lack of understanding within the SEC of the more intricate aspects of our financial markets, which they just didn't understand. So what Mr. Markopoulos describes as a combination of a lack of market experience and knowledge by the over-lawyered SEC, combined with an investigative ineptitude, which we're well aware of, that aspect has got to be addressed. And to have somebody examined 8 times by the SEC and other institutions in 16 years and have this not found when people were calling attention to it shows a structural flaw. And I think, rather than a lack of resources, this structural flaw is at heart of this problem. Why? Because it didn't just happen here. We also had this problem in Britain, as described to us by some of the British investigators, where they were over-lawyered as well. What is the proposed solution? Well, many have offered the idea of having retired people with market experience brought in so that you just don't have, in the words of Mr. Markopoulos, 20-something-year-old lawyers, so that you have people with real-life experience who can spot a Ponzi scheme in a New York minute in a position of responsibility where they can't be shut down by 20-year-old lawyers. And so I offer that up simply because he was quite insistent on that structural change in the organization, and we're appreciative of anything you can do to reset those priorities so that you actually have people retired with the kind of experience where they understand the market and understand these schemes. Thank you very much, Chairwoman.
Thank you very much, Mr. Rice. And now we'll hear from the gentleman from Texas, Mr. Hinojosa, for 1 minute.
Thank you, Mr. Chairman. Welcome, Madam Chair Shapiro. I want to thank our Chairman Kanjorski and Ranking Member Garrett for calling and holding this important and timely hearing today. This hearing will help us understand more comprehensively the role the SEC plays in protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital information. It's yet another step to help reassure our constituents that members of Congress and the regulatory agencies are taking the steps necessary to address one of the causes of the global economic crisis and prevent another one from reoccurring. We need to provide SEC with a considerable amount of funding, such as that included in President Obama's proposed 2010 budget. In fact, we need to increase it beyond his proposed $1.2 billion amount to perhaps $1.5 billion to ensure that the SEC not only is able to hire staff to fill the void at the SEC, but also increase the salary level of its employees to ensure that staff with institutional knowledge remains at the SEC. Again, I want to thank you, Mr. Chairman, for holding today's hearing. I look forward to the testimony of SEC Chair Mary Shapiro. I yield back.
Thank you very much, Mr. Hinojosa. And now we'll hear from the gentleman from Texas, Mr. Henserling. 3 minutes.
Thank you, Mr. Chairman. And clearly this hearing is being held against the backdrop of the administration's financial markets reform legislation. It's a piece of legislation of which many of us are concerned. First of all, it certainly would seem to enshrine us as a bailout nation. Yet as history is our guide, I know of no nation that has been able to bail out, borrow, and spend its way into prosperity. By designating certain firms as systemically risky, we almost guarantee that there will be more Fannie and Freddies, which ultimately will prove to be the mother of all bailouts, I'm sure costing the American taxpayers hundreds of millions of dollars, billions rather. In addition, this Office of the Consumer Financial Product, we would call it Financial Product Politburo, that ultimately will decide whether Americans can have credit cards, which home mortgages they can hold, whether or not they can even have access to ATM machines, is regulatory overkill and the nanny state at its worst. The underlying assumption is that our economic turmoil has somehow been caused by lack of regulation. It wasn't lack of regulation, it was dumb regulation versus smart regulation. If you come up with the wrong diagnosis, you're likely to get the wrong remedy. For example, look at the derivatives issue that was discussed just last week in a joint hearing between our committee and the Agriculture Committee. Again, we know that the most high-profile meltdown in this area happened at AIG with their credit default swaps. Yet in sworn testimony before this committee, the head of the OTS, AIG's regulator, said, you know what, we had the expertise, we had the resources, we had the manpower, and we had the regulatory authority. We just missed it. We made a mistake. It's another data point that it's not always more regulation that counts. It's perhaps smarter regulators and smarter regulation. Now, others have spoken about the Madoff scandal. Clearly, again, the SEC had the tools, seemingly they had the expertise, seemingly had the manpower, and in many cases were notified, but for whatever reason, they just missed it, and all the suffering and the setbacks to the economy have occurred. We look at the matter of the rating agency oligopolies, and I certainly believe that some good work is being done in this area by the SEC. But for the SEC to essentially have the NRSRO rule that created an oligopoly in rating agencies contributed mightily to our economic turmoil that we see. Again, I have a number of reservations about the administration plan. There's a number of areas that we can talk with the chairman of the SEC. I appreciate her appearance today. I look forward to the testimony. I yield back the balance of my time.
Thank you very much, Mr. Hensley. And now we'll hear from the gentleman from Florida for 2 minutes, Mr. Klein.
Thank you, Mr. Chairman, and good morning. Nice to see you again. I appreciate you taking on this important responsibility as chairman of the agency. You've heard from a number of our members about the concerns of what's happened in the past, and I would probably respectfully disagree with some of my members. Some of this was not just a question of lack of regulation or over-regulation or quality personnel. We've talked about the fact that I think that there has been whether it's intentional or otherwise, it seems like there's been an effort over the years by some of the members of Congress and others to say we need less. It's not a question of less in quantity, but we don't need the smarter kind of oversight that is necessary. And in my background, I was a securities lawyer years ago. I worked with the SEC. I understand what some of the shortcomings were and some of the strengths. But overall, I think there's been almost a deliberate attempt over the years to not compensate people at a fair level and losing some of the talent, and some of the members have recognized that. And I think as we move forward, it's not just a question of more or less. It is a question of the right type of oversight that can help investors understand what they're buying, what they're selling, companies understand what their responsibilities are. It's not that complicated, and I think a little common sense would go a long way here instead of sort of political posturing. This is the right thing to do at this moment. I also want to touch briefly on the Madoff situation because there's a lot of concern. I'm from Florida. A lot of people in Florida, unfortunately, lost a lot in this situation, and the SIPC, at least in my impression so far, has not been moving very quickly, and the trustee has not been moving as quickly as necessary to get these people made whole. Some of these people lost everything. Some people lost part of their assets, and they're not getting responses from the SIPC. And I believe there is a responsibility of the SEC to provide statutory oversight of the SIPC. And I would ask that you, with your staff, take a greater role in helping resolve this as quick as possible. We don't want to have to spend millions and millions of dollars for these people in court with lawyers. We want to get them whole to the extent that they're permitted to be whole with the Securities Investor Protection Act backing them up. So I'd just like to ask for that and look forward to working with your staff and working on some new oversight regulations that will help our investors in the United States establish confidence. Thank you.
Thank you, Mr. Pine. Now we'll hear from the gentleman from California for 3 minutes, Mr. McCarthy.
Thank you, Mr. Chairman. Thank you for scheduling this hearing today so we can hear from the new SEC Chair, Mary Shapiro, about your agenda. The last time this committee heard from the SEC was to discuss the Bernie Madoff scandal prior to your tenure. And I will tell you, I was frustrated with the responses that the members received regarding the SEC handling of the Madoff Ponzi scheme. It seemed as if the right hand didn't know what the left hand was doing. To try to fix this, I introduced legislation to restructure the SEC, to return inspections and examination functions to their original location within the Division of Investment Management, Trading, and Markets. This change would streamline operations at the SEC and reduce their current stovepipe structure, where those charged with inspecting and examining organizations are entirely separate from those who set the policy. With that said, I do appreciate you coming, and I look forward to a new direction and a new restructuring. I yield back the balance of my time.
Thank you very much, Mr. McCarthy. And now we'll hear from the gentleman from Michigan, Mr. Peters, for 2 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Shapiro, for testifying today. The current financial crisis, of course, has numerous causes, but in my view, one of the principal concerns that must be addressed is the way in which corporations have stopped serving the interest of their shareholders. Too often we have seen large companies run for the benefit of management and corporate boards that no longer answer to the shareholders who actually own the company. I'd like to hear more today about the efforts that the SEC has undertaken pursuant to its statutory authority to empower shareholders to have more control over board elections, executive compensation packages, and other major corporate decisions. I'm also interested in hearing your thoughts about other steps that may need to be taken by Congress to supplement the efforts that the SEC is taking. This committee is currently working on comprehensive regulatory reform legislation that will give the SEC and other agencies the resources they need to look after shareholder interest. I believe in addition to empowering regulators with new and improved authority to watch over our nation's financial health, we should also empower the owners of these companies to have more control and to align management interests with long-term shareholder value. I look forward to your testimony today and having an opportunity to hear your thoughts on these very important issues.
Thank you very much, Mr. Peters. That concludes our opening statements. So I now, with great pride, introduce and welcome as our only witness at today's hearing, the Securities and Exchange Commission Chairman, Mary Shapiro. Without objection, your statement, Ms. Shapiro, will be made part of the record. You are recognized for 5 minutes summary of your testimony, and then I suspect you should be prepared for a barrage of questions. Mr. Chairman.
Thank you very much, Chairman Kanjorski. Thank you for your lovely introduction. Chairman Kanjorski, Ranking Member Garrett, members of the subcommittee, thank you for the opportunity to testify today on behalf of the Securities and Exchange Commission. In my 5 months at the SEC, we have been singularly focused on rebuilding investor confidence in the capital markets and in the SEC itself. To that end, we have begun implementing many changes designed to better serve and protect investors and promote investor confidence. Indeed, there is an invigorating sense of urgency among the staff of the agency to demonstrate that we are up to the job. Since I returned to the agency, we have been working to fill regulatory gaps exposed by the financial crisis, seeking to strengthen the protections for investors against crimes such as those perpetrated by Madoff and other operators of Ponzi schemes, enhancing corporate governance to hold boards more accountable to shareholders, improving our risk assessment capabilities, and bolstering our ability to respond through enforcement more quickly and effectively, and bringing on new leadership and new skill sets throughout the agency. As I conveyed to you in February, the Madoff fraud is one that the agency tragically did not detect, and not a day goes by that we do not regret that. In a few weeks, our Inspector General will be issuing his report outlining why he believes the SEC missed the Madoff fraud. But I understood when I arrived that we could not wait to begin making significant changes, and that is why we have been implementing many new investor protections, some of which I'd like to highlight. First, we are reinvigorating the SEC's Enforcement Division by streamlining our procedures. Within days of becoming chairman, we changed our procedures so that enforcement staff can issue subpoenas and negotiate corporate penalties without first getting full commission approval. And our enforcement focus has squarely shifted to higher impact cases brought in a timely way. Additionally, our new enforcement director, Rob Kuzami, is reducing bureaucracy by streamlining management within the Enforcement Division, putting many more talented investigators directly to work on cases. He is also creating specialized units which will help to concentrate staff expertise and better coordinate investigations. Since the end of January, as compared to the same period last year, we have filed 3 times as many emergency restraining orders, opened up more than 40 additional investigations, and issued over 100 more formal orders of investigation. In terms of cases, we have brought fraud charges against operators of the Reserve Primary Fund, which broke the buck last fall, unsettling the money markets, pursued high-profile figures in connection with an alleged kickback scheme involving New York's largest pension fund, brought the first-ever hedge fund insider trading case involving credit default swaps, charged the former Countrywide CEO and other former executives with securities law violations, and expanded our case involving Alan Stanford to include the former head of Antigua's Financial Regulatory Commission, who allegedly received bribes and helped Stanford to thwart various federal inquiries. This is just a small slice. There are many more investigations in the pipeline. Second, we are strengthening our examination program. We are doing that by recruiting more professionals with new skill sets and expertise in complex financial instruments, trading, financial analysis, risk management, and valuation. Significantly enhanced training and fraud detection is also being provided to our examination staff. Further, because we have only 425 examiners for the more than 11,000 regulated investment advisors and 8,000 mutual funds, we are improving our risk-based methodologies for detecting and focusing on potentially fraudulent firms and activities to maximize our ability to protect investors. Third, we have proposed rules to substantially strengthen the controls over custody of client assets held by investment advisors or their affiliates. Among other things, these custody safeguards would encourage investment firms to place their clients' assets in the care of truly independent custodians. Under the proposals, firms that do not do so would have to obtain a special custody controls report from an independent audit firm. And in addition, all advisors with control of client assets would be required to undergo annual surprise exams by independent auditors to verify client assets. Enhancing custody controls is just one of the many rulemakings we've undertaken at the SEC. We have also sought comment on several proposals to restrict short selling. We have proposed a series of rules to empower shareholders through proxy access, as well as through provision of better information in the proxy. We have sought comment on a series of money market fund reforms to tighten credit quality, maturity, and liquidity standards. We have been actively considering ways to strengthen the integrity of the credit ratings process, and we have been reconsidering a decade-old proposal to challenge the so-called pay-to-play practices by investment advisors to public pension funds. And finally, tomorrow we will be considering a proposal that would result in greater and more timely information being provided to investors in municipal securities. Mr. Chairman, I want to thank you and the committee for your support of the SEC, and I look forward to discussing with you our other activities, our thoughts for additional legislation, and the state of our resources and reform of the regulatory landscape. Thank you.
Thank you very much, Madam Chairman. Sounds like you're off to a great start. Part of the questioning I have, I think I hear from many of my constituents, particularly after the most recent financial crisis in the country, They ask the question, why, after mistakes are made by people in various positions of government, particularly in the regulatory area of government, you never seem to hear of anyone being fired. I don't want to suggest you have wholesale firings, but what's your philosophy in terms of, if there's failure at the agency, not only from the past, but on in the future, are you going to implement some sort of more stringent accountability to employees to do a good job so that they aren't necessarily lax in how they pursue enforcement or investigative? I mean, I'll be honest with you, in the Madoff situation, I sympathize with the constituents of my friend from New York, Mr. Ackerman, that when you hear some of the stories that we heard in the testimony of the Inspector General, that only for the use of a single question, if somebody turned around when they were examining the Madoff operation and just said to Mr. Madoff, "Where are the securities?" That would have resolved the problem, that there weren't any, and therefore there was something fraudulent going on. And yet nobody asked that question. And now I think it's important enough to highlight so other people don't miss those questions in the future. So maybe if you could lay out your philosophy in how you intend to get a higher response to regulatory activities within the agency during your tenure.
I'd be happy to talk about that. I'm a very big believer that we have to hold people accountable at all levels of the agency for performing the responsibilities that have been entrusted to us by the American people. We also have to be honest to undertake what I think we are doing right now, a very honest assessment of what were our failings and what were our shortcomings with respect to Madoff, and frankly any other issues where we were not perhaps as quick to the draw as we should have been or could have been. One of the things that we're engaged in right now, as you know, the review by our Inspector General that I expect will reveal much more of the fundamental causes of our failure to detect early on and prevent or stop early on the Madoff fraud. In the meantime, we've tried to pull all the lessons we can, whether it's from the stovepipe structure of the organization creating issues, whether it's from a lack of skill sets so that the people who received the information from Mr. Markopolos didn't understand what they were looking at, whether it was a resource issue, whether it was an inability to track and follow up on the material received. We've tried to pull all the lessons we can from those failings and move very quickly to put in place as many different changes in how we operate as possible. So, for example, the goal of creating specialized units within our enforcement division, one of which will focus on Ponzi schemes, is really a response to the Madoff failure. The new custody rules to fill a gap in regulation that would have made it, if not impossible, very difficult for Madoff to do what he did. Those new rules that we've proposed are a response to that failure. Bringing in new skill sets across the agency through our risk assessment program as well as directly into the examination program, again, are a response very much to the Madoff failure. The fact that we have asked this committee to create whistleblower legislation to allow us to work more closely with whistleblowers and leverage that third-party resource and expertise, again, is a very direct response. So my view is we have to be absolutely open to learning all the lessons that this tragedy can teach us and moving ahead to put those kinds of changes in place in a very aggressive way.
Thank you very much. I'm sure that you're going to do your best. We're going to be watching, though. I assure you that, too. I'm going to pose my second question quickly, if I can, because my time is running out, but it's not done with the intention of embarrassing you or the administration. But I'm curious if we don't now take the opportunity to reform some of the structure of government, particularly the CFTC and the SEC, by merging them. And I understand all the political ramifications of, and we've had meetings on end over the last several weeks on those discussions. But I put the question the other day to the Secretary of the Treasury as to why in their white paper they didn't discuss that seemingly natural possibility. And if we don't do it now, after this disaster, what do you see the future planning of this administration or government as to when we will start to do what appears to be conflicting agencies that could logically be merged and accomplish better ends? I'm going to end it there and not put you any further on the spot than that.
Well, I think that the administration, having made the decision not to seek full merger of the two agencies, really puts the burden on the SEC and the CFTC to work together more effectively than they have over the course of the last 35 or so years that the CFTC has been in existence. And we're both quite committed to doing that. We've been charged with an effort to harmonize our rules to the greatest extent possible, and we're fully engaged in that process right now. But there will still be areas of uncertainty. There will still be the potential for products to be created that fall between the lines of the two agencies, and we will have to be extremely cognizant of that possibility so that we don't allow new unregulated markets to flourish between our two areas of authority.
Thank you again. We're going to be watching that too.
I appreciate that.
And that concludes my time, and now we'll hear from Mr. Garrett, New Jersey, for 5 minutes.
And I thank you. Again, thank the Chairwoman. As the American public watches this hearing today, they probably think in some respects that we've been here before. I appreciate Mr. Capuano's comment he's gone now, where he said everything, in light of everything that's happened in the past, he's appreciate the fact that everything's going in the right direction now, which is good. But the public might say, well, we've been here before, because, you know, if you think over history, and some of these things happened before I was in Congress, you had the mutual fund market timing issue in the past. You had the missed accounting scandals in the past. You had the analyst conflict issues during the dot-com issues in the past. All these errors, if you will, by the SEC in the past, and assume that there were probably other hearings like this after each one where the SEC, someone else other than you, would come back and say, we realize we made some mistakes, and now we're going to fix them with X, Y, and Z. And probably somebody on this panel probably sat here and said, well, we're glad that they were now going in the right direction. I mean, we've talked about already the Madoff situation, what somebody hasn't mentioned so far, of course, is the SEC also responsible for investment bank oversight and the Bear Lehman situations as well. So the list just continues. In one respect, it seems like the SEC is always coming in after the fact to the table, always a different chairman, saying we realized our errors and now we're going to try to correct them. And that, of course, probably leaves the American public questioning the veracity of the SEC and also the Congress as well in order to do its job. And that probably leads to the tremendous frustration that the public has for all this. One of the issues that's been addressed so far is the administration's proposal in a number of different areas. One of them is the President wants to give the SEC the power to insure in the area of compensation. And he wants to make sure that it does not skew investment advice. So just 3 quick questions. Is that something that the SEC specifically asked from the administration for that power? If so, did you work closely to try to come up with it? And how would you try to address that issue?
Thank you. Let me just say that I think to some extent all regulators, not just the SEC, play catch-up with the fraudsters. And perhaps that will always be the unfortunate way for us to operate, although we're not going on that assumption. We are really working very hard to build a risk assessment. I'm sorry.
Let me finish that thought.
To build a risk assessment capability to try to get ahead of the curve of the problematic practices. And we could, I guess, end all problematic practices, but it would be a pretty heavy hand of regulation in order to ensure that none of them were ever perpetrated against the public.
Well, that's a good point, because so you either go in the over heavy-handed approach, which is suggesting what some of us suggest what may be coming out of the administration right now, or you can go in completely the other direction. Maybe we have to find in the middle where you still ask for personal responsibility from the individual in these cases. But if you can get to the point with regard.
Yes. What the SEC has been interested in and what we worked with the administration on was the ability first of all, we've done compensation disclosure rules at the SEC within the last couple of weeks to try to require forced disclosure, required disclosure of how compensation plans incentivize long-term and short-term risk-taking within the corporation. And we have always approached compensation from a disclosure basis at the SEC. We have sought the ability to regulate investment advisors and broker-dealers as to the standard of care that they need to provide to customers. Right now, they are actually regulated under different regimes because of their different compensation models. Investment advisors seek compensation for a fee. Broker-dealers seek transactional compensation. As a result, even though they may both be providing advice to retail investors.
Is that I don't have much time. Is that a fiduciary standard that you're looking to be applied?
We're looking for a fiduciary standard
right.
because from the perspective of investors, I'm getting advice from a financial services professional.
Right. Again, I apologize.
I'm
I
sorry.
have so much time. Can an advisor receive a commission and still come under a fiduciary standard in your understanding?
Well, advisors generally don't get compensation-related, a transaction-related compensation. Broker-dealers do, and what we're saying is that it should be not how they're compensated, but what they're doing that gives rise to a fiduciary standard. So if you're giving advice, whether you're a broker or an investment advisor, the act of giving advice should require that you adhere to a fiduciary standard.
Right, but then the aspect of the first part of the question, as far as giving the power to set compensation schemes, would then commission-type compensation schemes go in opposite direction from where you want to go with meeting the fiduciary standards, or meeting those, making sure that it's in line with what the administration wants to come out of this?
I guess I'm not exactly sure how directly we would set compensation schemes. We would like to see, for example, the end of retail price maintenance that would allow brokers or advisors to offer mutual funds without having to adhere to the sales prices that are quoted in the prospectus. We would like to be able to see much better disclosure with respect to compensation schemes so that investors understand exactly what it is they're paying for.
Okay, thanks a lot.
Thank you, Mr. Garrett. Gentleman from New York for 5 minutes, Mr. Ackerman.
Thank you, Mr. Chairman. Madam Chairman, the issue that I addressed in my opening statement, to refresh your memory, is the Madoff victims and the terrible situation that we're looking at, where we actually have classes of victims pitted against each other, in addition to all the other confusion. Which Madoff investors are eligible for their SIPC insurance?
Congressman, let me just say that this is it shouldn't be such a difficult issue, but it is, and of course it's a very heartbreaking issue, because the tragic truth is there is not enough money available to pay off all the customer claims. And as you point out,
That leads, if I could just interject there, a larger problem, because that means that our citizens are not entitled to have confidence in the system.
Well, there is no doubt that what has happened with Madoff has shaken everybody's confidence in the integrity of the financial services industry and in the regulatory system to protect investors. With respect specifically to the SIPC question, as you know, the trustee has chosen a cash-in, cash-out view when determining net equity on which claims and at what amount to pay out. There are a group of investors who believe that so that if you paid in $2 million, over time you took out $1 million, your net equity would be $1 million. There's a group of investors
But these unfortunately are people that we have encouraged and assured by virtue of the fact that we provide the supervision. And these people knew that there were questions raised about Madoff, and the government basically gave him a clean bill of health year after year. People knew about Mr. Markopoulos. People knew about other people as well that had raised questions that were dismissed, and then felt the government is saying that this guy's okay. And the $1 million I put in has grown over the years, and I have this much money to live on now.
I understand that, and there is a group of investors who feels very deeply that their net equity on which they would be paid should be determined by looking, as you point out, at their last account statement. So they may have paid in $2 million, but that amount of money has grown to $10 million, and they were relying on that $10 million to be there for them.
Well, they weren't relying on the $2 million, which they were, of course. They were relying on the government's assurance that they had the $2 million. And they made life decisions based on that.
I
So
understand.
where do you come down, Madam Chair?
Well, we've been meeting with SIPC and with the lawyers for the investors who would like to calculate the net equity based on the last account statement in hopes of trying to find a way to settle this matter between the two groups to expedite getting these payments out to people who are very dependent upon them. These investors have challenged the trustees' cash in, cash out methodology in court, and that is before the bankruptcy
We're going to
court.
have to make a decision, and someone has to make a choice here.
I understand,
A woman, here's a case, a woman who has a small business, publishing business, she sells it for $3 million. She's taking out of, and that's everything she owns in the world, $3 million. It's in Madoff. She gets a check for $30,000 a month that she's taking out, which is the money she's making on it. Still has the equity in there. She buys a huge apartment in Manhattan. That's the only asset that she has. The asset is now underwater. She spends the $30,000 a month paying her taxes, paying her mortgage and her maintenance and her living expenses. She's done this for a couple of years. Suddenly, 1 month, when Madoff turns himself in, she has no income. The unit she lives in is upside down, as they say. She can't sell it for what it's worth. She owes $15,000, $20,000 a month in carrying charges, can get nothing from it if she sells it, and has $1,500 in her bank and is waiting for her $30,000 return from Madoff. She's homeless. She has no assets. Her $3 million has been stolen. And then on top of that, she's being told that the $30,000 a month that she's gotten, that she's paid taxes on with half and half to her mortgage, she suddenly owes back because of a clawback thing that they're claiming. Where's she going to get the $30,000 a month that she's collected to give back? I mean, these people are absolutely destitute. And they were reliant on the government's seal of approval that this guy is legit, that he's up and up. How can we turn our back on these people?
We cannot turn our back on them, and we should not turn our back on them. And I'm committed to working as aggressively as we possibly can with SIPC to take the most expansive possible view of how to repay these claims and to do it in as quick a fashion as they possibly can. That specific issue is before the bankruptcy judge right now. I don't have, although I'd be happy to get for you, some indication of timing when it might be resolved. But I agree that we need to push very hard to make people whole to the greatest extent possible.
I thank you for your concern and your actions. Mr. Chairman, if I can just have another couple of seconds to add. Some of our colleagues have raised an accountability question, and I just want to compliment the chairman. That rather bombastic initial hearing that we had with people from the agency before us that got an awful lot of attention because it was the first one. The chairman called me immediately after the hearing and says she was aghast at some of the things that she had heard during the testimony.
You mean she called you too?
Yes, she did, and even me. And by the end of that week, 2 of those people were gone from the agency. And I just want to say that that's accountability that I've never seen in my 14 terms here. And I want to thank the chairman for her swift action and dedication to her mission.
Thank you.
Yield back the balance of my time.
Thank you, Mr. Akron. And now we'll hear from the gentleman from Alabama, Mr. Baucus.
Thank you, Mr. Chairman. Chairman Shapiro, I mentioned last Friday that Secretary Geithner made this statement that they would require regulators to carefully police any attempts by market participants to use spurious customization to avoid central clearing and exchanges. Now, my concern is that every day American companies enter into hundreds, if not thousands, of these derivative agreements and customized derivative agreements today, and yet there's no requirement that they clear them today. So they're not fashioning them today. They're not customizing them today to avoid this rule that the administration says they're going to put in place. So, number one, I mean, do you agree that this is going to be pretty complex, difficult to police these derivative agreements?
I think it's a great question. I do believe in the approach that should encourage the maximum standardization as possible to get as many of these instruments cleared through central clearinghouses, which will reduce systemic risk pretty dramatically, even to get some of them on exchanges so we can actually have real pre- and post-trade transparency. But I do also agree that there is a need and will continue to be a need for businesses to be able to hedge their particular needs for commodities or financial protection in a customized way. And I think I honestly can't tell you that I know how we would police specifically at this point whether or not products that could have been customized are for some other reason, could have been standardized, are for some other reason being customized. And what we would do about that. I do think the incentives will be there to move things into the more standardized format, even without the regulators necessarily policing them,
Sure.
Because it is envisioned that for the standardized product, the capital requirements, the margin requirements are likely to be lower. The costs of transacting are likely to be far lower than they are for the customized product. So I believe the incentive will be for any industrial business that wants to hedge its exposure to a commodity or to a currency, for example, will be inclined to go the standardized route because it will be the most efficient thing to do.
Sure.
But where it's not going to work for them, they will have to bear the additional costs likely of taking the customized approach. And we as regulators will have to figure out exactly how we're going to police that.
Yeah, he didn't say whether it was a pre-approval process, or which I don't think would be workable at all. I guess you'd have to decide ex post facto. And, to me, you would have to get inside the minds of these corporations, and I'm not sure that you have the expertise or could hire that expertise.
Well, I think that the industry would have a right to expect from the regulators some significant guidance on exactly what constitutes standardized and what constitutes customized, and it would almost surely have to be a look back and not a pre-approval process.
But even reviewing all these customized derivatives would be an incredibly complex job.
I don't disagree, and I can't tell you that we've thought through exactly how that would happen at this point.
And you'd have to make the business decisions that really, as to what the corporations did and why they did it. And as I said, they're doing that today, so it's not obviously to avoid a rule. You're going to increase supervision of credit rating agencies. One of the things that's been talked about, preventing companies from shopping around for favorable credit ratings. How do you envision doing that?
Well, that's an issue I'm particularly interested in. As you know, the SEC has engaged in multiple rulemaking since it got authority under the Credit Rating Reform Act in 2006 to provide disclosure for the prevention and the disclosure of conflicts of interest and so forth. But I've been particularly interested in the idea that as an issuer of a structured product, would like to get a good high rating for that product to be able to sell it. And so I will shop around and get preliminary ratings from multiple rating agencies and then be in a position to pick the highest rating. One of the areas we're looking at, there are two things we're looking at specifically to respond to that. One is that we could require issuers to disclose all of those preliminary ratings. So if some of them weren't AAA, investors would at least know that. The second would be to require on a confidential basis disclosure of the underlying loan data for a structured product, for example, to all the other rating agencies who could then perform an unsolicited rating and make that rating available to the marketplace. So again, you would have some competition and you would have some diversity of perspective about the quality of a particular security being brought into the marketplace.
I think every member of this committee applauds you on your focus on credit rating agencies. I think if they had done their job properly, we could have avoided the majority of the problems we find ourselves with today. And I suppose your special examination on their role in the financial crisis will shed more light on that.
That's right, and we're also looking at whether, because ratings are enshrined in many SEC regulations, we're looking at creating a roadmap to lessening SEC reliance on ratings in our regulatory.
And just on the three, the oligarchy that I think has been set up.
Yeah, it's a highly concentrated business. I think over 95% of ratings are done by the top three firms.
Which our Republican plan also addresses. Thank you.
Thank you, Mr. Baucus. Now we'll hear from the gentlelady from New York, Ms. McCarthy.
Thank you, Mr. Chairman, and thank you, Chairwoman Shapiro. We have talked before, I've met and asked questions back and forth, and especially on the confidence what the SEC has to do to bring to the consumer and the investor. And I know that, everybody looks at the Madoff case and how many millions and billions of dollars were lost there. But I think everybody is forgetting, and anybody that looks at their 401k, they're not forgetting. People that were thinking of retiring can't retire. Those that are retired are in straits. And so your job to build up confidence with the American people again is going to be a difficult one. And even when we see the reaction of the financial institutions and the banks that they don't want any of these regulations. And they are fighting us. The lobbying that's going on here is unbelievable. And yet we are supposed to be taking care of our constituents. So one of the things that I was thinking when you were giving your testimony with regard to the many open investigations and cases the Enforcement Division is now working on, how is that being relayed to the public and the consumers? And in your opinion, should enforcement updates fall within this CFPA, or is that something you would like to maintain within the SEC?
Thank you. Well, I think everything we're doing at the SEC now is geared towards trying to reorient the agency towards investor protection. We've spent a lot of time, I think, historically worrying about capital formation and the ability of U.S. businesses to compete internationally, and those are all important. But right now, our focus is very much on restoring and rebuilding investor confidence, which frankly is critical, I think, to the success of our economy over the long run. And an important part of that, as you point out, is enforcement cases, because that shows the public we are there on the job trying to protect them, and we've stepped up our enforcement efforts very significantly. We relay them to the public really through the media, and we count on the press to write about the cases that we bring, the dozens of temporary restraining order cases that we've done, over 40 in the last several months, have gotten very good publicity, particularly in local markets. And those help to both educate people going forward about the problems, but it also helps them to think of the SEC as a place where they can bring information so that we can pursue it. I feel very strongly that the SEC's enforcement program, it's under terrific new leadership, a new director, a new deputy director, a new head of the New York office, a new organizational structure being rolled out over the next several weeks, new skill sets and new resources that we hope to bring in over time. Will make this, once again, the premier civil law enforcement agency in the federal government. I think the enforcement of the securities laws very much needs to stay with the Securities and Exchange Commission, and the dislocation and disruption that would be created by trying to move it into the CFPA or to take investor protection out of the SEC and all of its different permutations, because it's about so much more than just enforcement, would really leave us with a very fragmented regulatory regime. So I would expect that if a CFPA is created, we will work very closely with that agency. There will be areas of overlap and adjacencies that we will want to coordinate on but I feel very strongly that SEC enforcement needs to stay integrated with the rulemaking and the policy functions that we engage in.
The final thing that I'll say, and I'm speaking for my constituents, they didn't lose the millions and millions of dollars that might have been invested in the Madoff scheme, but their $200,000 that they might have had in their retirement, and they're not going to get that back. When the reports come out that someone in their 60s, middle 60s, even higher, it will take 12 to 15 years for them to get that money back. They feel kind of burnt that they're not getting any help, and they won't be getting any help. And I think that's a shame, because you're turning off an awful lot of people. There's probably more money under somebody's mattresses these days than even going into the banks, which haven't been any help. I hope that you're going to be able to stand up to the financial institutions. I hope that you can restore the credit to all the financial institutions, because there are a lot of good people that work in those in jobs. But I have to say, the pain that the majority of my constituents, and probably so many constituents around the country, they're not going to trust any of us. And to be very honest with you, I can't blame them. But thank you for your job, and I wish you luck in it.
Thank you.
Thank you very much, Ms. McCarthy. And now the gentleman from California, Mr. Royce, for 5 minutes.
Thank you, Mr. Chairman. Again, Chairwoman, let me ask you a couple of questions here, and this goes to a couple of the observations that Mr. Markopoulos made, and one was the vast differences in fraud cases that he was focused on that had come from industry tips as compared to those who had come from an audit. And clearly his desire was to try to get resources into running down these tips that are turned in. But let me just read you what he said in his testimony here before the House, and then get your comment on it. He said, first, I would replace the senior staff at the SEC because they have the wrong senior staff right now. And then I would go to the bottom of the organization. You need to change who the people on these teams are down at the bottom. They can't be young 20-somethings without industry experience. You need to get higher, senior, seasoned professionals. And the third thing you need to do, you need an office of the whistleblower to centralize these thousands of complaints that they get so that they're handled ad hoc by 11 regional offices. You need one centralized location, the office of the whistleblower instead. That's his view on that. Now, I know some of the senior staff has stepped down since that hearing. What do you make of the other suggestions?
I'd be happy to address this. Let me start with the Office of the Whistleblower to handle complaints. First of all, we have asked Congress to give us, to enact a whistleblower statute to give us the authority to compensate whistleblowers in the hopes that they will bring us well-formed and well-developed evidence of fraud that the SEC can then prosecute much more quickly. And we're very hopeful that that will pass, and it was also included in the administration's legislative package.
And the concept of the Office of the Whistleblower instead of doing it through 11 regional?
In fact, very shortly after I arrived, I learned that we receive between 700,000 and 1.5 million tips every year at the SEC. We are a tiny agency to handle that kind of volume. So we brought in, and they come in, as Mr. Markopoulos points out, every district office around the country and multiple offices within Washington. There's no central computer system. There's no tracking. There's no ability to look for a trend or a pattern of conduct across complaints coming from different areas, and there's no capability to combine that information with external sources of information. I brought in the MITRE Corporation's Center for Enterprise Modernization almost within a month after I arrived, I believe, to do a top-to-bottom review of exactly how we're handling all of these tips and how we might get to a system that could centralize them for triage, tracking, and resolution purposes. They've completed phase 1 of the work, which was a complete review of all existing processes. We're in phase 2 now, which will create new procedures for the entire organization. And then phase 3 is procurement of a technology that will provide a centralized IT solution for handling these tips agency-wide. So we're moving very aggressively on that count.
Let me ask then one other question he brought up while I have time. He said he thought the SEC was over-lawyered, to use his words, and he believed, and the SEC officials later affirmed, that there was a fundamental lack of understanding of some of the more intricate aspects of the financial markets within the SEC. The exception to that he cited was Ed Munyon in the Boston office, who'd actually been a trader and been a portfolio manager, but therefore was frozen out by the Washington and New York offices, which he viewed also as being over-lawyered. Can you comment on this idea of the SEC being over-lawyered and that kept them or maybe prevented them from uncovering the Madoff incident over the years? And I know you've taken some reform measures already, but what specifically is the SEC doing to address this problem?
I'd be happy.
And maybe along the lines that we had talked about with him, bringing in retired people who really had the kind of experience in the market that they could identify scams like this. Well, just like Ed Munyon, people like that.
Let me start by saying that we have really an amazing staff at the SEC. We have people who are committed to their core to serving the public interest, to enforcing the law, to getting to the right answer that will serve investors. And it's important to be said because it is in fact true, and that is the backdrop against which all the changes are being made, that we have something very important there that we need to grow and provide the resources and the training to make better. That said, we are recruiting actively for people with trading experience, risk management experience, portfolio valuation experience, forensic accounting, financial analysis. I mean, Wall Street's bad news in terms of having to lay off many people has been very much good news for the SEC, and we're able to recruit people with tremendous industry experience and expertise and bring them into the SEC, and we're taking full advantage of that opportunity right now.
Thank you, Chairwoman Shapiro.
And now we'll hear from Mr. Lynch of Massachusetts for 5 minutes.
Thank you, Mr. Chairman. Madam Chair, I want to thank you for your attendance at this hearing today, and I appreciate the work that you've done. I think the SEC is in good hands, and I think you've made a lot of changes in an institution that isn't necessarily inclined to change. To follow up on Mr. Royce's questions, he talked about Mr. Markopoulos's valid complaint that the SEC was over-lawyered, as well as Harvey Pitt, former chairman as well at the SEC, wrote a great piece called Over-Lawyered at the SEC, raised a lot of same points. What are you doing specifically to get folks in that could help make these more, I think, financial-based analyses rather than simply a legal analysis?
In two ways, we are actually specifically recruiting for those new skill sets to come into the agency. The first is within our examination program. We are, as we post positions, as we have available headcount, we are actually seeking people with very particular skill sets like valuation, risk management, trading, sophisticated structured products, over-the-counter derivatives, and so forth.
Great.
The second is that we have an Office of Risk Assessment that's quite small. We're building it rather significantly, and this year we created an office, Risk Fellows program. We have a very successful Accounting Fellows program. We bring in very senior people for a period, perhaps only of 2 years, but to come to the agency and both train our people in very current ways of Wall Street, but also to help us build the risk assessment capability so that we can take the resources we have and focus them where they're most likely to do the maximum amount of good for the integrity of the markets and the protection of investors. So through the Risk Fellows program and through our general recruiting, we are really looking to broaden our skill sets in examination and in enforcement.
All right. Let me ask you then, following up on that, and that's all good news. The President's regulatory reform framework envisions an exchange for derivatives, let's call them standard linear derivatives, over an exchange, but then also custom derivatives trading privately and in a more opaque system. These are custom derivatives. They're the more complex ones. These are the ones that generate a big payday for these banks, and are custom derivatives for the individual client, and yet those are often exchanged. So I'm just wondering, from your standpoint, not from the systemic risk perspective that the Fed has to worry about, but from your standpoint, how do you think you are equipped to deal with that type of bifurcation? Are you going to be able to handle both of those situations as at least the President now envisions them?
The SEC has a long history of dealing with both exchange, traded, and centrally cleared products, as well as over-the-counter products. So I think we have the institutional expertise to do it. I do think for the custom derivatives that are not centrally cleared, the key to success will be both transparency and the regulation of the dealers who are engaged in those transactions. So examination of those dealers, review of their risk management processes to make sure that they're stress testing, that they know their counterparties, that they are collecting margin, that they have credit limitations on traders, they have adequate documentation. I think it's really going to be essential, and they have appropriate sales practices and business conduct rules in place. Going to be really critical for the regulators, the bank regulators for many of the dealers, the SEC for others, to have very hands-on oversight of the dealers in the customized products.
Okay. Mr. Chairman, my time has expired. I yield back. Thank you.
Thank you very much, Mr. Lynch. And now we'll hear from the gentlelady from Illinois, Ms. Biggert.
Thank you, Mr. Chairman, and thank you, Chairman Shapiro, for being here. I've got just a couple questions. First of all, what's your opinion of the new derivative tax that's been proposed in the recently passed cap and trade bill? Do you support it, or do you have fears that such a tax and additional restrictions will send U.S. businesses and jobs abroad?
Oh, I'm afraid I'm not that familiar with the cap and trade bill. I'd love to be able to come back to you with a more thoughtful response.
Could you do that in writing?
Absolutely.
I appreciate
Thank you.
that. Then, in response to Mr. Royce's question, you mentioned forensic accounting and risk management, and that you're recruiting individuals with expertise in this area. Are you also looking into new technologies and outside firms with that kind of expertise? Thinking of whether you have modeling or central data base.
Absolutely. We have a program going on right now where our risk assessment office is reviewing multiple different technologies and services that do valuation, that can run tests of performance numbers, for example, for hedge funds and others, to help us understand whether we have a pattern of improbably consistent and good results coming out of a particular investment vehicle. And it will be very important for us to enhance our technological capabilities. I will tell you, the agency's technology, well, I was a commissioner 20 years ago at the SEC and left about 15 years ago. I haven't seen a dramatic improvement in those 15 years from when I arrived this year. And I think it's, given sufficient budget resources, we really need to devote some time and attention to building the technology that will allow us to keep up with the most technologically enabled financial institutions in the world.
Thank you. Then last year, former SEC Chairman Chris Cox banned short selling of stocks in nearly 1,000 financial firms. And later, I believe he stated that he regretted imposing the ban and that its cost appeared to exceed its benefits. Given that these rules and comments were made at the beginning of our current financial crisis, Does the SEC now seem to think it's a good idea to heavily restrict the short selling?
Well, I think what Chairman Cox was referring to were outright bans on short selling, as well as as some other requirements the SEC put in place. And the analysis that was done after that period does show that while it resulted in lower short selling, as you would imagine, it also resulted in lower liquidity and much higher volatility. What we're doing is quite a different thing. We're looking in a very deliberate and thoughtful way at whether reinstatement of the uptick rule that had been in place for many, many years up until 2007 ought to be reconsidered in our marketplace, which does not stop short selling, but only permits short selling when the last prior transaction was done at a higher price. So we're looking at reinstatement of that rule, or as an alternative, a circuit breaker, so that if a particular stock declined by, say, 10%, short selling might be prohibited for a period of time thereafter in that stock. We put all of our proposals out for comment. We had a 60-day comment period. We've gotten 4,000 comment letters that we're now working our way through to determine what our next steps might be.
So the comment period is over, and now you're...
Comment period ended June 19th, but it's not an emergency action. It's not being done in haste. It's being done in what we believe is a very thoughtful and deliberative way. We had a roundtable publicly held and brought in all different perspectives to talk about this issue, and we're trying to take it in a very though deliberate way.
Do you have any date for when you expect that
I'm
both will
hoping
be
that by
finalized?
the end of the summer we may be able to come back to the commission with a proposal. I honestly don't know where the full commission stands on the multiple proposals that we published for comment.
Okay. Thank you very much. Thank you for being here.
Thank you, Ms. Biggert. And we'll now hear from the gentlelady from California, Ms. Spear.
Thank you, Mr. Chairman, and thank you, Chairman Shapiro. I've got to just add my praise to all that's been showered upon you today. It is remarkable what you have done in a very short period of time. I was astonished to read the new GAO report, though, that suggests that in the last 3 years, SEC has reduced the number of disgorgements by something like 80% and the number of enforcement actions by 60%. We can't have that happen again, and I want your advice on what we should do to make sure that your agency becomes the toughest, most scrupulous cop in the nation. And if it takes more staff, I want to give you more staff. I'm concerned by this chart here, which I presume has been given to us by you, that shows that the growth in the enforcement staff is something like 23%, but the growth in tips and complaints has gone up 146%. The growth in SEC staff is up 15%, but the growth in trading volume is up 264%. If we've learned nothing else in the last few months, it's that there wasn't the vigilance at the SEC, and so many people on Main Street are hurting today because the SEC wasn't doing its job.
I will say on the budget that the SEC had a long period from 2005 to 2007 of flat or declining budgets. And in fact, even with the President's request for 2010, we will still be 4%, have 4% fewer staff than we did in 2005. So in the last 2 years, Congress has been very good and very supportive of a growing SEC budget. But the fact is, we are, as I said before, a pretty small agency. We have over 35,000 regulated entities. We have 3,600 employees. And that's not a great ratio by any standard. If you think about the 11,000 investment advisors and 8,000 mutual funds where so many Americans entrust their money, we have 400 examiners.
We need to give you more staff, and that's my point. Next question. I'm concerned about what I perceive to be a potential revolving door problem at the SEC. Whether he was involved or not in decision-making, the attorney that was overseeing the Madoff case ends up marrying the niece of Mr. Madoff, who was also employed at the business. Another firm was being scrutinized. The particular lawyer, I believe, at the SEC then leaves the SEC and goes to work for that particular company. I do not believe that any SEC employee who has had a responsibility over an enforcement action should be allowed to go and work for that company in the next 2 years. What is your opinion of that?
It's a very fair question, and the revolving door, it's a problem for many agencies. It's a problem for the SEC. Certainly. We are looking at a couple of different models. The bank agencies have some limitations on your ability to leave a bank, banking agencies, and go into a regulated institution for some period of time. And so we're looking at those. Here's my dilemma. I need to get the best and the brightest to come to the SEC and do what we do. And I fear that if I put too many limitations on their exits down the road, they might not be willing to come in the first instance. So I'm acutely aware of the revolving door problem, and I'd like to find a solution to it. And I haven't figured out the correct balance yet, but I'm committed to working on that.
Rating agencies. I was astonished to find out that when they testified before our committee, they take the information that the issuer provides them and do not do any due diligence to determine whether that information is accurate or not. So question number one, should there be a higher responsibility there? Secondly, should there be some kind of liability that the rating agencies incur when they rate an AIG as a AAA or a Lehman at an A minus, and then 2 days later, both of those institutions are defunct?
Well, I will say that the SEC has very recently done rules that require disclosure about the level of due diligence that they engage in when they're rating structured products, and the extent to which they go beyond what information they have been handed directly by the issuer. So hopefully that disclosure will be helpful. I think with respect to liability, I would speak for myself and not for the SEC, because I don't know the views of my colleagues on this, that I think private liability could have a very important effect on the quality of the efforts that rating agencies are making.
My time has expired. Thank you, Mr. Chairman.
The gentleman from Delaware, Mr. Castle, for 5 minutes.
Thank you, Mr. Chairman. Chairman Kanjorski, I have an op-ed that appeared in the Financial Times, authored by Lawrence Mitchell, who's a law professor at George Washington University. I asked to be entered into the record.
Without objection, so ordered.
Thank you, sir. It's entitled, by the way, Protect Industry from Predatory Speculators. And that, Chairman Shapiro, is what I want to ask you about. And I want to cite from that article. I won't read the whole thing. It's pretty long. But in the article, he stated, in the first place, shareholders are hardly an oppressed class. The beneficiaries of shareholder access rules will be the pension funds and mutual funds who hold billions of dollars of corporate stock. True, they hold it on behalf of ordinary Americans, but the managers of these funds have their own interests that often conflict with those of their beneficiaries. Managers thrive by increasing their portfolio's value. That is a hard thing to do, and it takes time. So for years, fund managers have increased their pay by putting pressure on corporate managers to increase short-term stock prices at the expense of long-term business health. Doing business that way puts jobs and sustainable industry at risk now and in the future. He goes on and says, for example, managers responded to the pressure by using their retained earnings to engage in large stock buybacks. In the 3 years to September 2007, companies in the S&P 500 used more money to buy back stock than to invest in production. With retained earnings gone, all that was left to finance production was debt. When the credit markets collapsed, these corporations could not borrow and thus could not produce. Are boards and managers to blame? Sure, but so are the big shareholders who have been pushing management for this kind of behavior for years. They are more the problem than the solution. Enhancing their voting rights will only make things worse. I'd be interested in your comments concerning that portion of his statement.
It's a great question. My view on this is that at the end of the day, the shareholders are the owners of the corporations and ought to have the ability to influence the election of directors in a meaningful way. And you and I have had some limited discussion about the Commission's new proposals on access to the proxy. But that's what our goal has been as we've proposed ideas about which I expect we will get thousands and thousands of comment letters. But it is a view that the shareholders of the corporation are entitled to vote for directors who are overseeing management, and that we need to make that as meaningful an opportunity as possible. That said, there's clearly a lot of short-termism in the perspectives of managers and boards and shareholders, which has not necessarily been completely healthy for the U.S. economy. One of the areas we see this particularly has been with compensation plans that reward short-term risk-taking or reward short-term results to the detriment of longer-term planning and investment and R&D. And through our new compensation disclosure proposals, we are hoping to get at some of those issues in a very direct way that will allow shareholders to see the benefits of compensation plans that promote a longer-term perspective on the affairs of the corporation and less short-term focus.
I, first of all, agree with your answer. I am very concerned that in the name of small shareholders that we're encouraging a lot of shareholder and proxy involvement when it may not be beneficial even to those small shareholders. Obviously, a lot of the bigger shareholders are trying to drive this, and I would hope that we keep that balance in mind. I'm aware that the stockholders are ultimately the owners and should have some proxy rights and control, but on the other hand, we certainly don't want decisions being made by corporations which could end up being counterproductive. So I appreciate your answer. I hope we will keep an eye on this as time goes by.
Absolutely.
If I could just ask quickly, some would suggest that if the SEC repealed mark-to-market accounting and reinstated the uptick rule, the capital markets would return to normal. Is this an oversimplification of a rather complex issue, and your thoughts on those two?
Yes, I would say it is rather an oversimplification. I think the uptick rule, we're obviously exploring very carefully. When the SEC took the uptick rule off several years ago, it was one of the most thoughtful, careful rulemakings that probably had almost ever been done. There was a pilot period, there were economic studies, there were multiple roundtables held, there were comment periods and so forth. Nonetheless, the markets have changed rather dramatically since that period of time, and investor confidence is something we have to be very concerned about. And so that's why we're doing this very careful reexamination of the uptick rule, and not clear at all, as I said before, where we will land with that. On the accounting issues, the SEC did a study at the end of last year, before my time, and on fair value accounting. And one of the things, the takeaways from it, while there were things to be tinkered with around the edges, was that investors, who we very much need in our marketplace and corporations need in order to raise money, value fair value accounting. It is important to them in making investment decisions. And the idea that we could eliminate fair value accounting and solve our problems, I think we would create many, many more problems down the road. So I think the approach that has been taken with respect to fair value to provide interpretive guidance and other assistance from FASB, I think has helped alleviate some of the pressure on that issue.
Thank you. And I yield back, Mr. Chairman.
Thank you, Mr. Chairman. Madam Chairwoman, for a number of years predating your time at the SEC, there's been some sense from the regulated community that the Commission was very good at nitpicking and not so good at catching some of the bigger things. I don't want to refer specifically to the Madoff situation, because I think for a number of years before that, there was just a sense that personnel at the Commission were very good at finding little detailed mistakes and doing enforcement with respect to those detailed mistakes, but weren't so good at seeing the bigger problems that might be present there. Do you have a sense of whether that's a fair criticism of the Commission predating your time, whether you think it's an ongoing problem, and how, if you think it's a problem, how do you think you can combat that?
I don't think it's an entirely fair criticism. I think the agency over the last several years has brought some very important and very major cases with respect to the Foreign Corrupt Practices Act, with respect to auction rate securities, insider trading, and so forth. So I think they've done a great job in many areas. That said, we are making it very clear now that our goal is to refer to state regulators and to other self-regulatory organizations cases that are not going to have a major investor protection impact, so that we can really focus our attention on very high-impact cases done in a much more timely way, because that's really how we protect investors. We shut down Ponzi schemes faster. We end accounting frauds faster. We stop insider trading rings faster. So we're trying to shift the focus to be larger cases brought more quickly. But I don't think it's entirely fair to suggest that only small matters were brought before.
Thank you, Madam Chairman. I hear you say it's not entirely unfair either, I think, implicitly in your answer. You had a colloquy a moment ago with the gentlewoman from California regarding personnel and a revolving door concern. I wonder if, given the fact that Wall Street has something of an unemployment problem right now, you're seeing an upturn in the quality of resumes to look at some of those bigger issues that you're describing the Commission doing such a good job pursuing.
We absolutely have, and just to give you one small anecdote, we posted several positions, I think 4 for risk assessment experts to come and join us, and we got over 500 resumes, so with some of which had just amazing experience on Wall Street. So we're fully taking advantage of Wall Street's pain.
It's good from a Commission point of view. I heard another discussion you had with the gentlewoman from California regarding rating agencies, and I want to make sure I heard what you said, because I think I agree with you, and I want to have you articulate it a second time. Would you believe from the Commission, from a personal perspective, Mary Shapiro's perspective, that imposing liability upon rating agencies would be a helpful check in the process of their rating various equities?
I think it could certainly make a very big difference, and we obviously want to be careful in crafting it. We want rating agencies to work. We want them to work effectively, and we want them to align their interests with those of investors. They're paid by issuers, but their audience is the investing public, and that's what we need to work on, incentives that will encourage that alignment much more effectively.
I think you would agree with me that the 3 rating agencies didn't work so effectively in the last year and a half on some of the big failures where the market didn't have the information the rating agencies perhaps could have shared more accurately.
I would agree they didn't work perfectly.
Are there other measures, other than what the Commission has already undertaken, that you would recommend that Congress consider, separate from the liability discussion you had with the gentlewoman and with me, that might help perfect markets, which right now in the rating agencies' context are clearly not perfect?
I would be happy to provide some additional thoughts on that in writing or in a separate meeting. As I said, we're looking at the ratings shopping issue through 2 different perspectives, because we're very concerned about that. We would like, I think, to move forward with more complete disclosure of the track history of how ratings have performed over time, so investors can see basically the quality of ratings and whether they measured up over time. Or they would upgrade and then downgrade, and how those were achieved. So we're looking at some additional disclosure as well.
I know I would welcome, I believe the subcommittee would very much welcome additional information from you, additional guidance on that.
I'd be happy to do that.
I thank you. I yield back.
If I could just go back to your question on the enforcement, because I do think it's so important for me to say the Enforcement Division at the SEC is full of people with tremendous energy and desire to bring cases. That's what they're there to do, and they're committed to doing it. And to the extent the Commission made that difficult for them, they may have focused on some of the less significant cases. But what I have found in my 5 months with just taking a few of the handcuffs off, that they have really stepped up to the plate and done a phenomenal job. And so I don't want anything I said to in any way suggest that these aren't public servants who have been really knocking themselves out over the last 10 years to try to do the best they can for American investors.
I suspect your words just empowered them further. Thank you very much.
Thank you.
Thank you very much. And now we'll hear from the gentleman from Texas, Mr. Henserly.
Thank you, Mr. Chairman. Madam Chair, welcome. I believe that in an earlier colloquy with one of my colleagues, you articulated a concern that the proposal to create a CFPA potentially could erode the consumer protection, investor protection mission of the SEC. If I don't want to put words in your mouth, did you say something along those lines?
What I said was the transfer of SEC enforcement responsibility to the CFPA would erode the SEC's overall ability to protect investors and to keep our rulemaking and policymaking connected to the enforcement arm of the agency. A linkage, I think, is
And what would be the
important.
consequences of that ultimately for the investing public? If Congress were to enact legislation that ultimately had that result?
That took the SEC's
Yes.
enforcement authority away? Well, I think what you'd find is that over time, the rulemaking function, which is often informed by enforcement cases, would be damaged. So, for example, when we bring enforcement cases because we found problems within a brokerage firm or an investment advisor, the results of that enforcement directly inform the policymakers about whether a new rule is necessary in a particular area, and it works going back the other way. I think of investor protection is all of a piece. It is enforcement, it is examination, it is rulemaking, it is the accounting standards and the disclosure requirements. Those are all part of the fabric of investor protection.
I believe you also said or acknowledged that you believe there would be some areas of overlap with a potential CFPA. What do you believe those areas of overlap may prove to be, and what are your concerns in that regard?
I think the possibility, first of all, I should say that as the legislation is currently drafted, there are actually some definitional issues that I think create
Well, there's several different
concerns.
pieces of legislation floating out there.
Well, the last one I saw talks about the CFPA will not regulate entities registered with the SEC, but have virtually everything else. The concern of that is public companies issue stock. That's very much an SEC-centered function that we bring enforcement actions for. We would not want to see this legislation preclude that, and I don't believe that that's what was intended. But the areas I see where we have a potential are hybrid products. Credit products are intended to be part of the CFPA. There's a possibility for hybrids, I think, to be created. Undoubtedly, as we sit here, a rocket scientist somewhere is devising a product that will fall in an unusual place within the regulatory regime. And so it will require a lot of coordination, I think, to make sure that doesn't happen.
With respect to a hybrid product, some type of investment product, isn't it true that an investment product may actually lower risk for one investor, yet the same investment product could increase the risk depending upon what investment portfolio the investor has, what his investing goals are? Is that not true?
I mean, that's why the SEC's rules and customer protection rules are really built on the concept of suitability, that a broker recommending a product must make a determination that that product is suitable for that investor.
So again, one product could be helpful to one investor, may prove to be harmful to another investor.
Sure,
Why many of us have the concern that under all the pieces of legislation we've seen with respect to the CFPA, that we have a body that ultimately can prescribe and simply outlaw certain consumer credit products. And so, again, I just make the point that a consumer credit product may be right for one consumer, may be wrong for another consumer. Let's move on in the very brief time I have to the subject of executive compensation. I believe I heard you say in your testimony that it's an area certainly the SEC is moving. I know that there are at least two broad proposals that are out there. I think we're in the comment period, I believe, on those. My question is this. Has the SEC undertaken a study to look at the compensation proposals of, say, J.P. Morgan, B of A, Citi, and is there any data that indicates that the compensation structures for those that were hardest hit by the credit crisis were somehow different than the compensation structures of those who navigated the crisis more successfully? And with the limited time I have, also with respect to the firms that have returned their CPP money, were they judged to have superior compensation structures than those that didn't return their CPP money as of yet?
I'm not aware of any study undertaken by the SEC. I do believe that compensation practices can contribute very significantly to risk-taking within a company. But our rules have been designed to get at the maximum clarity and disclosure about how that happens. So we have already and have had for years under my predecessors, very complete disclosure of compensation and a discussion by the compensation committee about how they arrive at different kinds of compensation programs within the company. What we are proposing to do now is expand that disclosure to ask for a discussion by the comp committee about the linkage between compensation programs and risk-taking, and also to disclose conflicts of interest of compensation consultants to the board who may also be doing work for management.
Thank you. I see I'm out of time.
Thank you very much, Mr. Henson. And now we'll hear from Mr. Himes of Connecticut.
Thank you, Mr. Chairman. I have a couple of questions relating to a specific matter I'd like to submit for the record, if that's okay. Thank you. And Madam Chairwoman, thank you for joining us, and I'd like to add my voice in praise of the efforts you have taken to date. Two maybe paradoxical observations and questions. The first is, with respect to investor responsibility, and you're going to hear me say momentarily how important I think it is that we get the regulatory apparatus correct. But I get concerned, frankly, as we talk about the regulatory apparatus, that we may lose the critical concept of the responsibility that investors have for understanding the risk of the instruments that they employ. As we talk about money market funds, which were never designed to be guaranteed against a breaking of the buck, or about alternative investments like the Bernie Madoff deal, I think it's critical, and the system will not work unless people understand that unless their instrument says guaranteed by the federal government, it is not, and they can lose it. And I guess I'd just love to hear you say that this is a thought and a concern of the SEC as well.
It very much is. This is a personal view. As a nation, we don't do a very good job educating, starting with our young people, about investment and why it's important, what the risks are, and what the individual's responsibility really is. And it's something I hope that perhaps this Congress or another Congress will take up in a serious way.
Thank you. Thank you. And I'm sorry, but just I know I have very limited time. I'm actually more concerned about question number two, which is it staggers me, frankly, that the conclusions drawn by this debacle, often on the other side of the room, are that because the regulatory apparatus failed, we should just throw the enterprise over the edge. It's dangerous and it's ahistorical. The history of the last 120 years in this country has been of a gradual development of a regulatory apparatus that has protected American families. 120 years ago, Americans ate rotten fruit. They burned to death in shirt factories that were not regulated. They bought securities that would make Madoff look easy. They bought snake oil. 120 years, we have evolved a regulatory apparatus that has dramatically increased the quality of life and the safety of the American citizenry. And the conclusion, therefore, that because we did it wrong, and boy did we do it wrong in the last 4 or 5 years, that we should just throw the enterprise away and leave everything to individual responsibility is dangerous and ahistorical. We have talked a lot today about the rules and the changes that have been proposed, but we haven't talked enough about the topic that I'd love to devote the rest of my time to hearing you talk about, which is the culture of your agency. We can get the rules right and everything else absolutely right, but unless the SEC has an entrepreneurial culture where people feel like they can take some risk, where they can raise their hand if they think that something is wrong, where they think that they are adequately compensated for doing their job well, we're going to fail. So I guess I'd love to just, in whatever remaining time I have left, hear you talk about what your vision is for the culture, the compensation of the SEC and its people.
It's a great question, and it is absolutely fundamental to our being able to do any of the things that we've laid out as being important. And I would agree with you that writing rules is great, and bringing enforcement cases is great and necessary, and getting the structure right is necessary. But we have to be able to tap into a deep well of energy and enthusiasm on the part of our people in order to make any of that happen. And I have to say, in my 5 months, I've been stunned by the willingness of people after a pretty long period of not raising their hands and not taking risks. I've been stunned by their willingness to do just that now. And some of the cases I mentioned in my opening statement, those are cutting-edge cases for the SEC. The willingness of people to come up with new ways to approach problems like Madoff gives us a list of actions that we've been able to take very quickly to try to respond. Didn't prevent Madoff, but hopefully going forward it helps us to prevent the next one. Those things are all important, and my experience has been, having been in and out of government my entire career, is that if you entrust people with the ability to make those decisions and do what they came to government to do, the results will be pretty good. And I will tell you, in my 5 months, that's exactly what I've seen at the SEC.
I see the gentleman.
Yield the balance of my time.
I see the gentleman has time. Will the gentleman yield?
I will yield.
If the gentleman could please supply the committee with which members on either side of the aisle has called for the entire scrapping of the entire system, I'd be curious. I think I've heard from both sides of the aisle. Over here, Mr. Ackerman saying that a member from his constituency having problems with the system, people on our side of the aisle saying they're having problems with the system, and that we're trying to get the right regulation. But if he has heard anyone say that they want to scrap the entire system and go back to absolutely no regulation, I'd appreciate hearing from him, because I've never heard that. And I think you yield back.
Thank you. Mr. Chairman, I yield back the balance of my time.
Thank you very much. And now we'll hear from the gentleman from Florida, Mr. Putnam.
Thank you, Mr. Chairman. I don't think I was next in line, weren't you? I think the gentleman from California beat me here.
Oh, well, we'll withdraw your recognition and.
Well, thank you very much.
Gentleman from California. For 5 minutes.
Welcome, Chairman. It was probably February last year I introduced an amendment to one of the housing bills, and it required the FEC and the feds basically to look to market issue and consider suspending mark-to-market or modifying it in some fashion. And it was funny back then, many people you talked to, when you mentioned mark-to-market, they kind of looked at you like a deer in the headlights of what are you talking about? I know Chairman Frank understood the issue, and the committee accepted it on a voice vote. And I think it took me 3 more times putting it in bills, and every time we put in the bills, the Senate would pull it out of a bill and not recognize the situations banks were going through today. And according to the feds, they give investors loan up to 90% of asset current market value today. And then the feds hold that asset and collateral in a non-mark-to-market account. Is that correct?
I'm sorry, I don't know the answer to that.
Okay. Have you been very involved in the mark-to-market issue?
Well, I've been involved in the mark-to-market issue from the perspective of the FASB and the SEC's oversight of FASB. And the SEC produced a report last year on fair value or mark-to-market accounting, which led to FASB's April guidance that was issued with respect to how companies should value assets for fair market purposes, meaning that it's the price that you would get for an asset sold in an orderly market as opposed to having to go with a fire sale price.
Okay. Under the terms and conditions of the TAF program, it states, quote, TAF loans will not be subject to mark-to-market or remargining requirements. Is that correct?
I assume so. I'm sorry, I don't know.
Okay.
I'd be happy to provide information.
Having been involved in the real estate industry for well over 35 years, you could see the problems that lenders were facing with the mark-to-market concept, especially in the declining market when you could not go out and determine the value of an asset because there was no market for the asset. Lenders not only made the loan, they were setting up huge reserves for prospective losses, or in some case losses they were taking on current foreclosures. Create a situation where the market basically became illiquid. It's an interesting marketplace we're facing today with banks. It seems like the feds have put a lot of money in banking industry today, and the banks are sitting on money. But the anomaly of that is they're not making loans, and for the average citizen who has money they want to put in a savings account, banks don't want the money. And so we've created an unusual situation that I think is having dramatic impact on the marketplace. And if you look how the mark-to-market has really had a negative impact on the banks today as it applies to residential loans, I think you see the same problem coming in the near future on commercial industrial loans. Are you current on the situation that the market's facing with those two areas?
Very generally.
We have experienced a huge decline in the residential marketplace in the last 2 to 3 years. Probably by the fourth quarter of this year, and I've been saying it for about 6 months now, you're going to see a huge foreclosure hit on the commercial industrial sector. But the problem with that is the bottom to that trough is probably not going to hit for 3 years. So you have a situation now where banks are not lending, they're not wanting loans because they have so many funds from the federal government they're holding, and they're going to be taking huge hits again on the commercial industrial sector. How is the revisions in the mark-to-market going to impact them or benefit them in the future?
Well, I think the way there are really two areas. One is the fair value guidance that was issued by FASB that makes it clear they do not have to price assets at fire sale prices, that they can use prices that would be received in an orderly market. And the second is with respect to other than temporarily impaired, which allows the banks to recognize fair value declines that result from volatility, interest rates, liquidity, to include those in other comprehensive income and not have to include them
That sounds
in earnings.
good. How do the regulators apply this to the holdings of the banks at that point in time?
I don't know how the bank regulators would apply the accounting rules or use them with respect to their capital requirements.
But don't you think that's germane to what we're trying to deal with there? Or it's going to be significant if you have two agencies looking at it from different perspective, you trying to resolve the market-to-market issue in some limited fashion, and the regulators are looking at it from a different perspective. Don't you think we need to do something to get those two together?
Well, we do talk with the bank regulators on these issues, and FASB has a very open door and an open line of communication with the bank regulators on all of these issues. So, for example, when the banks were going through their stress tests, they were utilizing information provided by FASB about what might be expected in the future, for example, with respect to off-balance sheet accounting, so that those tests could be more comprehensive. So there is quite close communication.
Okay, well, I want to thank Ranking Member Baucus and Chairman Frank. I have a bill that they're putting on suspension. It should be next week. And the banks are in a difficult situation. They're having to take homes back, and then the regulators are basically forcing them to put those homes in the marketplace because of mark-to-market and liquidity, and they're sitting aside because they're non-performing assets at that point in time. And basically what the bill does, it says that a lender can have up to 5 years that they can put the unit on the market as a rental, thereby getting it off the declining asset and getting on the performing asset market, which would change the mark-to-market value of it. And because in California, like San Bernardino County and the Empire, there's probably 78% of the homes in the marketplace are distressed sales from lenders. L.A. County is like 56%. Even Orange County, which is a very good market, is about 43%. And dealing with the same situation of trying to give them some relief because the regulators are forcing the banks to put these units out there instead of holding them, because banks are not really in the real estate business by law, but this gives them a 5-year window to try to deal with it. But I think the concern I have is that the regulators and you might not be on the same page on this.
Well, I can tell you, as I said, we have regular communication with the bank regulators with respect to accounting issues, and I think they have obviously great flexibility in the application of their capital requirements for banks. Greater flexibility than we have with respect.
Hope they demonstrate their flexibility in working through these difficult times.
I'm sorry.
I hope they demonstrate their flexibility in working through these difficult times. And I thank you for your patience, Mr. Chairman. I yield back.
Thank you, Mr. Miller. And now we'll hear from the gentleman from Michigan, Mr. Peters.
Thank you, Mr. Chairman. Thank you, Chairman Shapiro, as well, for your testimony here today, and I'd like to join others in applauding your efforts, and appreciated several of your comments. One of your comments that I found particularly welcome was that everything at the SEC now is related to investor protection, and I appreciate that statement, and I believe it has also been consistent with your record, particularly as head of FINRA. I had the opportunity to be an arbitrator for a number of years at FINRA, and know that under your tenure that organization continued to strive for excellence in protecting investors. And in follow-up to my colleague here, Mr. Himes, about investor education, I also had the opportunity to be part of an investor seminar that FINRA hosted in my district not too long ago, to really work to make sure that investors understood the risk related to investments and to make sound investment decisions. And I know that occurred under your tenure, so I appreciate your efforts. I also appreciated your comments to a question that at the end of the day, that it is the shareholders that are the owners of these companies. And in a capitalistic system, of course, it is fundamental to capitalism that the owners have the ability to exercise the authority that they have because of their ownership interest of those organizations. So my question is related to a speech that was given before the Society of Corporate Secretaries and Governance Professionals last month by Commissioner Walter. She discussed the SEC's efforts to enact new rules to empower investors in that speech. She specifically discussed proposed rules to give shareholders access to management proxy materials for the purposes of board elections, an SEC-approved rule on unrestricted broker voting, and improved disclosure of executive compensation and corporate governance. In that speech, she stated that, quote, legislation that reaffirms our authority would remove the distraction of challenges to authority that Congress had previously granted to the SEC. Do you also believe that it would be helpful for Congress to provide specific statutory authority to the SEC as it undertakes what I believe are very important reforms?
I do believe it would be helpful. The agency has gone down these paths before and frequently been challenged in court over these issues, and we may well be challenged this time around, particularly with respect to proxy access. So while we've gone ahead and done proposed rules that we believe make sense, it would certainly not be harmful in any way to have backstop statutory authority.
Great. And in follow-up, are there other reform measures with respect to corporate governance that you feel may be important, but would also explicitly require some statutory authority on our part to assist you in these efforts? Maybe you could answer it broadly as to where you think we should be going, but also where Congress can be helpful to you in those efforts.
Well, I think we are very focused right now on the issues we have outstanding: access to the proxy, the additional proxy disclosure requirements that we have gone forward with. We will be looking later this year at disclosures related to environmental issues, as those become very, very prominent topics of public policy and enormous costs for public companies as they seek to meet different standards under environmental legislation. We'll be looking at those issues. Again, those are disclosure related, so I don't think they will require legislation. I know that Congress has talked from time to time about whether there ought to be say-on-pay legislation. The SEC has gone forward with rules that were required under the Economic Stabilization Act to require a say-on-pay advisory vote for companies that are recipients of TARP funding. And it would be a question whether a say-on-pay should be extended more broadly to other public companies, although many of those advisory votes are being done now as pursuant to shareholder proposals.
Great. Thank you. Mr. Chairman, I yield back.
Thank you very much, Mr. Peters. And now we'll hear from the gentleman from Florida, Mr. Putman. If you start talking very quickly, that's it. We're not going to.
Thank you, Mr. Chairman. And I want to thank the chair lady. Let me begin with short sales. Your predecessor suspended them in the beginning of the economic crisis. He later stated that he regretted having done so and that the costs outweighed the benefits. What is your take on that?
Yes, Chairman Cox did make the statement that it was one of the worst mistakes that he felt they had made. And I will say that what the agency did last fall was done in a series of very quickly implemented emergency measures of different sorts, banning short selling, along with a number of other things. As we have re-examined short selling, we've determined not to do it in any kind of an emergency context, but rather to do it in a very thoughtful, deliberative rulemaking process. So we published several months ago 2 different approaches to not banning short selling, but restricting short selling. One is would essentially bring back a market-wide uptick rule that would require that you could only short sell when the last prior transaction was implemented on an uptick or an upbid. The other is a very focused rule that would apply to individual stocks, but not across the whole market, where if a stock declined by, say, 10% in a day, there might be a short selling restriction for some period of time thereafter. The comment period on those proposals closed on June 19th. We have close to 4,000 comment letters that we're working our way through. We also held a roundtable where we brought lots of experts, investors, financial services firms, exchanges, and others in to talk about the impact on the markets of short selling rules and the impact on investor confidence. We're factoring all of that into our process and our thinking, and we've come to no conclusions yet about whether or not to go forward.
Let me jump ahead to money markets. One of the most telling signs that we were in a non-cyclical economic crisis last fall was when a money market broke the buck and another closed just before breaking the buck. Your new rules, first of all, the additional government protection that has been placed in the money market funds world, will that, in your view, cause greater risk-taking among the money market pool of funds?
Well, that temporary guarantee program, I believe, expires in a couple of months. So what we have actually seen, though, is given the events of the reserve fund breaking the buck, money market funds actually tightened up on their quality and liquidity and maturity standards. So they went to higher quality, not lower quality, despite the presence of the guarantee fund. And I don't know that the Fed and the Treasury have come to any conclusion yet on whether or not to extend that. Our proposed rules are geared towards really bolstering the resiliency of money market funds going forward. So they're higher quality standards. We also propose that money market fund boards of directors be able to suspend redemptions when a fund breaks the buck, as the reserve fund did, so that all shareholders will get equal treatment in the distribution of assets, rather than those who are just quick to the draw getting in first when the fund has broken a buck and getting a higher payout. And we've also asked for comments on whether money market funds should move away from the $1 stable net asset value to a floating net asset value that might cut down on the chances for a run on money market funds.
And finally, the regulatory reform bill package that is being discussed, it's my understanding, does not include GSE reform.
No, that's right. I believe the decision of the administration was to engage in further study with respect to the GSEs and come back to that issue later this year.
Is it your view that these entities, which hold up to 50% of the mortgages in the country, would need to be part of a regulatory overhaul?
I think at some point we as a government are going to need to address the future of the GSEs, yes.
Thank you. Thank you, Mr. Chairman.
Thank you very much, Mr. Putman. Now we've had a request for a second round, and I've passed, and Mr. Garrett has passed, but we recognize the ranking member of the committee, Mr. Baucus, for 5 minutes.
Thank you, Mr. Chairman. Recently, FASB announced some changes in the securitization accounting rules. The Federal Reserve and other bank regulators have cautioned that the rule changes threaten the viability of the federal government's economic recovery plan, because that plan is partially dependent on restarting the securitization markets. And there has been some comment and concern that the accounting changes would actually throw into question the securitization model that we've been using in the past. Are you concerned about the timing and the scope of their accounting rule changes, particularly given the emphasis that the government, I think private economists, have in restarting the securitization market?
Well, I should say as a prelude to that the SEC is very interested in doing what we can to help assure a vibrant asset-backed securities market. And we have made a number of proposals that would require legislation that would allow for more continuous disclosure, so forth, for asset-backed securities. I think what FASB has done with respect to off-balance sheet is really very important. There's been a conclusion, or at least a view widely expressed, frankly, by governments around the world, that off-balance sheet accounting is a contributor to the financial crisis. And so FASB and other accounting standard setters have worked very hard to eliminate the exception that allowed a company to remove financial assets from their balance sheet when they transferred them to a special purpose entity, even though they retained an interest in the loans, in the cash flow from the loans. And I think it was a very important gap for them to close. I recognize, and maybe there's never a good time for new accounting standards to be put in place from the perspective, particularly of regulated entities, but I think it was a very important gap that needed to be closed. It goes into effect at the end of the year, and obviously we'll watch it very closely. But
now, you are aware that the bank regulators and the Federal Reserve has expressed some real concerns about it?
Well, I hadn't heard that they had recently expressed real concerns about it, although it doesn't completely surprise me, and we will certainly have conversations with them.
And when you do, when you talk to them, could you maybe, if you maybe respond in writing as to whether you think that if they still have those concerns, if there's merit?
I would be happy to.
Okay, thank you. You know, for the first time in the SEC's history, your budget is likely to cross the $1 billion mark. And, you know, with all the current responsibilities you have and the likelihood that you're going to have a greatly increased number of entities subject to your commission oversight, you know, that's not surprising. Do you think that the Commission can leverage the expertise of the existing and potentially new self-regulatory organizations to supplement its work? How do you perceive that?
Well, you know, my bias is I come from a self-regulatory organization where I spent 13 years, and so I think self-regulatory organizations with close oversight from the federal government, from the SEC in the case of FINRA or the New York Stock Exchange or the NASDAQ stock market, with close oversight can bring tremendous value to the protection of investors, and in the case of exchanges, the assurance of market integrity. So it's an area that we're willing to explore, because even though our budget's growing, we're likely to never have all the resources we need to do everything we'd like to do. And the extent to which we can leverage SROs, accounting firms, other whistleblowers, I am game to do that, because I think it will allow us to do a better job.
And to focus on the Bernie Madoffs of the world and things. Okay.
I
Do you
think
have
my
any
view is
any specific ideas on where you might go with that?
Well, we've engaged in quite a lot of work to try to be very responsive to the Madoff tragedy. And
no, I didn't mean the Madoff. I mean the private, the self-regulator.
I think, you know, again, I think the key to the success of self-regulation is really vigilant oversight by the SEC, and it's something that we don't have a self-regulatory organization, for example, with respect to investment advisors. We have not opined as an agency about whether that would be an appropriate thing for us to do, but I think given our resources, we have to consider every opportunity to leverage third parties.
Okay. Could I have one more question, Mr. Chairman? You know, for almost 30 years, we've had a financial products regulatory structure, which is divided into two categories, securities and futures, where you had two different regulators. And I know there's been a lot of discussion about where to go. I'm not going to ask you whether you think we ought to merge the CFTC and the SEC. I don't think you probably want to volunteer your opinion on that. But if you do, you're welcome to. I know we're the only nation that still has separate regulators. But given that there is a unique situation which does present some regulatory challenges, do you, and you're supposed to prepare, you and the CFTC are supposed to prepare a report to harmonize the offering rules, the regulations, and the regulatory approaches on securities and futures. What are some of the challenges facing you with this September 30th date coming up, and do you think you're gonna be able to do it by the 30th? And
Well,
I will throw in, and do you think there ought to be one regulator? But you don't have to.
I have said that I believe there is a logic and an efficiency to merging the two agencies. I think we have overlapping authorities. We have some arbitrary lines that have been drawn between the agencies over many years, and I absolutely understand the origins of all that. There would be a logic and an efficiency, but if we're not going to do that, then it really does behoove the two agencies to work together as effectively as we possibly can. And we're both, Chairman Gensler and I, very committed to doing that. We, as you point out, we have been charged with creating a report on harmonization initiatives by September. We're well into working through that and trying to identify those areas where the agencies have different rules and requirements. It's challenging in part because we also have very different approaches to regulation, and we grew up under very different circumstances. CFTC largely regulates an institutional market with a vertically integrated exchange and clearing structure. We regulate largely retail markets with multiple exchanges and clearing houses that are not vertically integrated. And just those two perspectives alone make this a challenge, but we're working in good faith to get as far as we can in this process of identifying the areas of difference.
Okay. And if you can't meet that deadline, of course, you'll ask for do you anticipate putting out some agreement and then working towards other areas of harmonization?
We haven't really talked through what we would do if we don't make it, on the theory that we have to keep the pressure on our staffs to see if we can make it. But my guess is we would put out some kind of interim statement, at least, about our progress.
All right. Thank you very much. Thank you, Mr. Chairman.
Thank you very much, Mr. Baucus. The chair notes that some members may have additional questions for the panel, which they may wish to submit in writing. Without objection, the hearing record will remain open for 30 days for members to submit written questions to those witnesses and place their responses in the record. Just take a moment. We normally dismiss the panel, but thank you very much, Chairman Shapiro, for, I think, really being forthful to the committee since your entry into this position and working with us over the last 5.5 months in a very positive way. We look forward to a continuation of that progress, and I want to thank you for being here. We thought we'd have you out before noon, but it's pretty close. And for government time, that's very good.
Thank you very much.
Thank you, Ms. The panel is dismissed, and this hearing is adjourned.